What is up, investors? How are we today? Hope everyone's doing well. Today we're going to be discussing some of my favorite technical indicators when trading, what they mean, and how they work. But first, I'd like to remind you lovely people, if you're still stuck on which broker to use, or you'd like to switch your current broker, I advise checking out Webull. It's a great platform for all investors of all skill levels. They also offer level 2 and 3 trading views free for up to 3 months. Always good to see that. And if you sign up with my link in the description, you can get free stocks valued up to $1,400 when you deposit only $100. Can't go wrong with free money. Alright, let's get right into it. The first indicator I like to talk about is the moving average, or MA. This is one you need to have in your bag of tricks if you don't already. Now, what is the moving average? The MA is a calculation used to analyze data points by creating a series of averages of different subsets of the full data stream. The reason for this calculation is to help smooth out a stock price by creating constantly updated average prices. This helps traders identify trends in a stock and can help gauge good buying and selling points. Commonly used time frames for your MA are your 50, 100, and 200 day moving average. Stocks typically tend to stick with these trends. Here you can see Facebook bouncing off the 200-day moving average, moving from a price of $245 to $285 over the course of the next 2 weeks. That's over 15% from bottom to top. Not too bad for just one indicator. You can also see Facebook bouncing off the 50-day moving average with smaller bounces, but still significant enough to catch and make money on. A couple drawbacks from the moving average are whipsaws. A whipsaw occurs when the price crosses over the MA, showing a potential buy or sell signal, then quickly reversing back over and showing the opposite signal. This tends to happen more frequently when using shorter period averages like 20 or 50, and less frequently when using longer averages like 100 or 200. Another drawback is the way the calculations work. It is slow to detect recent price movement. Because each period is given equal weight, day 50 or day 100 in the stock's price mean just as much as day 1 or 2. This will be referred to as a lagging indicator. The second indicator I want to talk about is the Exponential Moving Average, or EMA. This indicator is also a lagging indicator. What's different about the EMA as opposed to the MA is that it gives more weight to more recent price action. It is good for finding short-term entry and exit points along with overall trend direction and the strength of a stock. This is also good when day trading, for example, using the EMA 5, 10, 20 for short-term trends. You can see when the 5, 10, and 20 cross in a positive direction, this could be a potential buy signal around the 1750 mark. Then when they cross again downward direction as a potential sell signal around the 2050 mark. That would give you a little more than 15% in only a couple hours. Most positive movements won't be as much as that, but it's still good to show the usefulness of the short-term EMAs. Our next indicator to join the party is the RSI, or the Relative Strength Index, another must-have in the arsenal. The RSI is a momentum indicator that measures the magnitude of recent price change to evaluate overbought or oversold conditions in the price of a stock. The RSI is displayed as an oscillator. Now you might be asking, what's an oscillator? All it is a line graph that moves between two extremes with readings of 0 to 100, with a value of 70 or more indicating an overbought signal, and with a value of 30 or less indicating an oversold signal. So I try to draw a little graph here for you guys. This blue line is your RSI. As you can see, this is your 70 line, this is your 30 line, 100 up here, 0, 50. When the line crosses over here, would be a possible overbought signal. Overbought, overbought. And a possible downtrend of a stock price. Then when we get down here and it crosses below the 30, this is a possible oversold signal where you should buy and ride the trend back up. We as traders use this to find ideal times to buy and sell stocks. Knowing that a cross over 70 may mean the decline of a stock price, we can cut the position or sell the close before the change in trend direction even occurs. This is Investopedia, new and old investors' best friend. I get a lot of good knowledge in here, so I'll leave a link for it down in the description. So what can we learn about the RSI? Well, sometimes during a downward trend, the RSI will peak at a number lower than 70 for an overbought signal, and sometimes during an uptrend, the RSI will peak at a number higher than 30 for an oversold signal, as you can see here in this old GE chart. Let's talk about some RSI divergences. A bullish divergence occurs when the RSI creates an oversold reading, followed by a higher low that matches correspondingly lower lows in price. This indicates rising bullish momentum in the stock price and possible trading signal to trigger a new long position. A bearish divergence occurs when the RSI creates an overbought signal followed by a lower high that matches correspondingly higher highs in the price. This is indicative of a bearish momentum and possible trading signal to go short. And as you can see here, this chart of Bank of America shows a bullish divergence. Another trading technique examines the RSI behavior when it is emerging from overbought or oversold territory. It's called a bullish swing rejection. It has 4 parts. 1, the RSI falls into oversold territory. RSI then crosses back above the 30%. The RSI forms another div without crossing back into oversold territory. And then the RSI breaks its most recent high. And it looks like this right here. This is a good one to know. There's also a bearish version of this. The RSI rises into overbought territory. RSI will then cross back below the 70. RSI will form another high without crossing back into overbought territory and then breaks its most recent low. Another one you should probably know. Now let's go over our last trading indicator. This is going to be the MACD, or the Moving Average Convergence Divergence. And I know what you're thinking. What the hell does that mean? Well, the MACD is a trend following momentum indicator that shows the relationship between 2 moving averages of a stock. This is calculated by subtracting the 26-period EMA from the 12-period EMA. The result of that calculation is the MACD line. A 9-period EMA of the MACD, called the signal line, is then plotted on top of the MACD line. This functions as your possible buy and sell signal. You could go long in a stock when the MACD crosses above the signal line, and go short when the inverse occurs. This indicator can be used and interpreted several different ways, but the most common are crossovers, divergences, and rapid rises or falls. The MACD is often displayed with a histogram, which graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the baseline and vice versa. Traders use the histogram to identify when bullish or bearish momentum is high. Some drawbacks from this indicator are that it can often signal reversal, but then no actual reversal happens. It also doesn't forecast all reversals. Like any indicator, it isn't perfect, but paired up with a couple others, like the ones I've mentioned in this video, and it can be great use identifying possible buy and sell signals in a stock's price. Alright, so that's going to wrap it up for this video. You got your 4 indicators I think everyone should know. You got your MA, the moving average, your EMA, the exponential moving average, your RSI, the relative strength index, and your MACD, your moving average convergence divergence. I hope you enjoyed the video and gained some knowledge. If you did, please leave a like, that'd be greatly appreciated. And if you want to stay up to date with my videos, hit that subscribe button. It would mean the world to me. Leave a comment down below with any suggestions for future videos, and I'll try to make one specifically for that. As always, good luck in wealth, investors. Peace.